Welcome, everybody. Thank you very much for being here. Dr. Scholes has an undergraduate degree from McMaster University in Canada, has an MBA and a PhD from the University of Chicago. Dr. Scholes has taught in the classroom at MIT, the University of Chicago, is currently the Frankie Buck Professor of Finance Emeritus at Stanford University for the Graduate School of Business. That's a pretty impressive list of credentials. But I don't know if I've mentioned this or not. Dr. Scholes won the Nobel Prize in Economic Science in 1997 for his work on option pricing. And he won the Nobel Prize with Fisher Black and with Bob Merton. His work, if you've taken a finance class or a business class, you've studied the Black and Scholes model, the Black and Scholes option model. And this is the Scholes of the Black and Scholes option model here at the University of San Francisco to speak to all of you. Anyways, it is an honor and it is a thrill, and I thank you for speaking to all of us tonight here at the University of San Francisco. And with that, it is such a proud moment of mine to be able to introduce Dr. Myron Scholes.
Yeah, I guess you can see that. Thank you very much for the kind introduction. I have talked to you tonight about something that I'm very passionate about, and I have and I call the evolution of investment management, and I call it the cost of constraints. And so it's going to be fascinating to listen because I feel so close to this and so excited about what it is and what it can do. So I'll try to tell you what it is, but it's going to be really in two parts. Okay, is that really the way investment management has evolved over time is that we have initially first thought about the idea of evaluating performance of managers by saying, what could we do naively? So you just evaluate their performance relative to a benchmark. And over time, what has happened is that instead of saying, let me just evaluate your performance relative to benchmark, that what I observe around the world when I go around the world and talk with endowments or others, that basically that the idea of staying close to or just evaluating relative to benchmark has been the idea that we have what's called tracking error constraints, which means that not only do you evaluate someone relative to benchmark, but you constrain them to stay close to the benchmark. And so I have a paper that you can access on my website at Stanford, or my homepage at Stanford, which actually goes into consummate detail about this and does a lot of the modeling and the empirical testing of it. But the idea is that when in life, when we have a constraint, and the interesting parts about constraints themselves have a cost. And then when there's a cost, what do people do to mitigate the cost of the constraint and how they behave? And when you mitigate something or try to avert the constraint or act within the constraint, then that might have an implicit cost in the sense of a lost return. So today I'm going to talk about these implicit costs or lost returns in the dimension of having to stay close to a benchmark or having a tracking error constraint. And the second part, which is not yet on my homepage, which will be soon, is the idea of thinking about all investment has moved to the idea of how are we doing relative to someone else, or how am I doing relative to a benchmark. And that is not what investors are interested in. I know we don't eat relatives. You know, we might have them for dinner, but we don't eat them. And so, but most of our life is really talking about what we want to do is maximize the value of our portfolio, maximize the value of investments we make, have the best terminal wealth experience that we can have, and subject to some type of drawdown constraint. We don't like to have large drawdowns because that means we have a loss. A drawdown in our portfolio value is a loss. And so we're interested in that. And if we think about averages or average returns and the Sharpe ratios and everything we teach in school and class that permeates through the whole industry, not only in the United States, but around the world, Europe, China, Asia, the rest of it, Japan, etc., then basically it leads to averages which are static when you think about averages, and it has also an implicit cost in terms of loss return. And so the interesting part of life, or the part of investment, is that the return, the distributions, the things we deal with are always changing. I mean, they're not constant or static over time. And this is very important to realize that. When we first started in the profession, we didn't have the data. Well, I didn't have the data. So it was easier just to assume distributions were normal and distributions didn't change. And when you assumed that, that allowed you to have very wonderful results that were kind of simple. And even in the Black-Scholes model, you know, Fisher Black and I, when we did the technology, we allowed everything to change and very dynamic, and then we couldn't get a closed form solution, so that what we did is assume that the volatility was constant and that returns were normally distributed, log normally distributed in a compound sense. And but those were only assumptions. So the interesting point is that my belief is we have to refocus our thinking away from average returns or average performance relative to a benchmark and go to compound returns. That's how the growth of your portfolio changes over time. Not averages, not an average, okay? And I'll explain what they are. And compound returns really are most enhanced by not concentrating on the middle of the distribution. The middle doesn't mean anything. It's really fascinating. But all the ups and downs, the little ups and downs, forget them. They don't mean anything. We all concentrate on middle and the distribution, little ups and downs. Everything in investment is determined by the tails of the distribution. The tails are the extremes. And what I mean by the tails, it's not only the downside loss that you suffer, but in life, it's missing the good as well. And the good is very important. So it's a combination of the down and the good. And basically, they have to figure out how to mitigate tail losses, the losses in the extremes, and participate in tail gains, the good ones as well. And the fascination about compound returns, it's each period of time. If you lose 90% this next period, it's going to take a long time to come back. Each period counts. If I start with 100 today, and I go over a period of time, and I lose 50% today in the first period, and I triple my money, I end up at 150. If I triple my money first, and I lose 50%, I still end up at 150. The order doesn't count. In compound returns, you're multiplying 1 plus the returns, so it's compounding over time. And basically, every period matters. And the interesting thing is then I realized, once again, came to the idea compound return is crucial. Every period matters. Then where do I get information about the risk or the distribution of possible returns? And then I said, let me get information and believing in market prices, I believe that I can get information from the option market, not as to the mean, because the options under Black-Scholes really are priced as if the expected return is equal to the risk-free rate, but I can get the distribution of risk relative to the assumption of the risk-free rate and how that distribution is changing each period of time. So I can look at the market, and the market can tell me. So when you have a situation where the market price of protection in the tails of the distribution are increasing, that means the insurance price is going up, the risk is going up. And you can take information and use that to enhance your compound return. The same way, when I was starting off in university, I used to drive home and just take the crowded freeway to get home. But nowadays, I crowdsource. You know, I can use Waze, and the information in the crowd tells me. And since risk, I'm going to show that the mean doesn't matter in returns. It really doesn't matter in dynamics of return. The most important thing is risk and the dimensions of risk and how risk are changing. That's what really takes us in terms of thinking about things. And we have information about risk in the option market. The option market has a lot of information about how risks are changing, because that's where people are actually buying protection against risks. And it's very fascinating. So I've also had Philip Anderson quote about the tails of distribution. And you know, as Michelle Obama was taken by Mrs. Trump, I figured that Philip Anderson took some of my ideas as well, and a physics guy. But the physicist in physics has it interesting, very interesting, because physics has myriad observations. You know, they can run experiments. In economics and the like, we don't have that luxury because things are changing. They're not static, they're changing. And when things change, we can't look at huge long periods of time. You know, what happened in the 30s is not maybe germane to now, and so things are always changing. But they don't have market prices. The physicist doesn't have market prices. We have market prices, prices where people are actually buying protection and changing the risk and telling me what the risks are. So we'll talk about that and get back to that, okay? So I think really the future course, if I can talk about the evolution of asset management and thing, is to really maximize the terminal value of portfolios. Compound returns are crucial, not average returns. And also using the fact that the distributions of risk are changing all the time, and as a result of that, you end up with an ability to use information in the market to actually enhance returns. Another important fact that's very important, just to give you an illustration, that if you go over time, we always talk about cross-sectional diversification, or the idea, you know, don't put all your eggs in one basket. When Tobin was awarded the Nobel Prize in economics, it was the case asked by the press for his one-liner. He said, I was awarded the Nobel Prize for saying don't put all your eggs in one basket. Okay, so that's cross-sectional diversification. Now, if cross-sectional diversification works, time diversification works too. And we only have one run of time. We can't cross-sectionally diversify in the sense that most of statistics is based on repetition, or, you know, the law of large numbers. You have a chance to get the average by completely resampling all the time. Life is one run of time. We don't have n runs of time, you know, to get the average. So basically every period matters, and if you have a target level of risk, keeping your risk at target is so much, as we'll show, is really free. If you can figure out ways to keep your risk at target, you don't hurt anyone else by doing it. If you allow your risk to fluctuate around target, your terminal value will be reduced. That's a fact. It's a mathematics. The mathematics of compound returns tell us everything. Okay, it's all mathematics. It has nothing to do with my intuition. It's just how compound returns work. And compound returns, as I'll show you in a few minutes, are really all a function of risk and how risks are changing. So if you can use the markets to tell you how to keep your risks at your target, you'll be much, much better off than allowing your risks to fluctuate around your target. So time diversification is keeping risks at your target level and not letting them fluctuate. And I'll show you why in a moment or two. So as I say here, the mean of the distribution is your average return. You know, that's the different means in the distribution, but also there's different shapes. And when we deal with a normal distribution, or assume these shapes are constant over time and not changing, it's a whole different world from the world we live in, where the distribution of risks are changing quite dramatically. In 07, 08, the distribution of risks were far different from what they were, say, last year or this year, and all of us are always thinking in those different risks and how the risks are changing. So I think that basically relative return investing in how people evaluate themselves relative to others is, I saw the movie The Titanic, and I saw that on the upper decks of the Titanic, people were drinking champagne and having a good time, and unfortunately people on the decks below were drowning first. So relatively they were in good shape, but absolutely they weren't in very good shape because the boat was sinking. So you have to really think about absolute returns are everything and not necessarily relative, as we tend to be forced to do things. So in asset pricing world, what I've been trying to think about is rational ways of thinking about why people impose tracking error constraints, staying close to a benchmark, having a residual error for the technicians here less than 5%, and it's to avoid potentially cheating and reducing explicit monitoring costs. In other words, if I can measure you relative to others in a class or relative to anyone else in other ways, then I don't have to work very hard. I can just say, okay, how'd you do relative to this? And I can go home and not have to worry about how you do it. But I think that I found that there's a lost returns associated with that. It's not free. And so the interesting thing in investment is, how do you gain trust? How do you gain trust? How do you create trust among the various individuals you manage money for? That trust is so crucial, because the more trust you have, the more you can deviate from the benchmark. The more it allows you to trust you to be able to deviate from the benchmark. And it's a key issue. The great investment houses that I've studied and worked with are the ones that are able to generate trust. But when you have trust, you have to use trust. You can't necessarily have trust and not use it in a productive way. And if you stick to the benchmark and never deviate, or deviate very little from it, you'll have really lost returns, and it has really a potential cost. So I have got a paper with Ashwin Alankar and Peter Blaustein, as I've said, on my website, and it reiterates what I said here about costs being high. And managers who manage money love to be able to have a benchmark constraint, because the fascinating thing about active managers is when they don't understand things, when you have shocks, when things get tough, they tend to diversify back to the benchmarks. So they go back to the safe harbor. Their safe harbor is the benchmark, because then they say, oh, everyone else, the benchmark went down, I went down, I'm perfectly the same as everyone else, so what should I have done differently? And you told me that you wanted me to stay close to the benchmark. So I think that we trade off explicit cost of evaluation, explicit cost of generating trust, with that of thinking in terms of lost returns. So what we find is that with a tracking error constraint, the manager finances their active investments by using lower volatility stocks. What I mean by that is, if a manager tends to love high-risk stocks, medium-risk stocks, and low-risk stocks, how do they finance it? they would tend to finance it by those stocks that have the least, and those stocks that have the least tracking error constraint are those that have lower volatility. You know, it's not going to have much effect on the benchmark. And two, stocks that are very highly correlated with the benchmark. So they're the ones they liquidate. And so what we find is that, yes, that's what they do, you know, and from our empirical work, they do that. And what that means is that they tend to overweight higher risk stocks in their portfolio and underweight the lower risk stocks. But at times of shock, they completely reverse everything and go right back to the benchmark. Okay? Because what we find is that if you believe you're in something like I can achieve extra returns, you want to have more invested in those classes. You get extra return, but the greater the uncertainty of your extra returns, the less certain you are about your skill at that moment, then you tend to reduce your risk and bring it back to the benchmark. So we find that higher risk assets underperform, potentially as a result, and which is consistent with the theory, or the empirical evidence that, you know, so constraints do have an effect on portfolio performance. I just have here that lower volatility stocks tend to be underweight in the index, okay, 66 versus 56%. And for Ludwig, who said he wanted me to be very technical, I had this slide from our paper, and this actually has all the mathematics of what I just said, but I'm going to let him talk to you about that in the questions. Okay, so I'm going to skip this slide, but I think that I like to talk about asset allocation and the constraints are costly. One of the great things in investment, and you'll remember this if you want to be an investor in that, is if you can understand the constraints of others and you can figure out a way to mitigate those constraints, you can make money. Because what the investors are doing is paying you to take risks. They're paying you to take risks. And that paying you to take risks is the idea of understanding the constraints. In life, we talk about bargaining. We talk about the bargain is such, great bargains are such that the other party to the bargain gains something and I gain something. It's not as a current president of the United States thinks. It is that everything's a zero sum. You know, if I win, he loses, the art of the deal, okay? No, the bargaining game is both win. I win, the other party wins. And so the generalized bargain in investing, the anonymous bargain, is if you can know others' constraints, you can help mitigate those constraints. They'll be better off and you'll be better off by taking actions to do that. So I think that what we've had in our world is a constraint that basically asset allocation strategies have a common approach, which is actually a benchmark and tracking error. But what we find is that for many years, it's been that you have 60% stock and 40% bonds. That tends to be what individuals talk about. Or when you're young, you should invest in equities, and when you get older, you should invest in bonds. Those are standard names, but they don't have any risk to them, and the glide path and the distinction is completely arbitrary in the sense that the right question to ask is, when you're young, how much downside risk are you willing to take? When you're old, how much downside risk you're willing to take? How you build that portfolio might be very different at different times because of the investment world that currently gives you these opportunities. For example, in 1980, when I started investing, it was the case that bonds were yielding 14 or 16%, you know, and I thought maybe they were, even though I was young at the time, you know, it seemed like a good investment to me. Today, for example, the long bonds are intermediate, even 10, 20-year bonds don't seem like such a great investment to me, even though I'm old, you know. So I'd rather think in terms of risk and how to manage things. So I think that I really am trying to talk a lot to investment managers about dynamic risk management and how to do it. And I'll just describe that in the period and the time I have left to go here. This is a fact about terminal wealth. And I know all of us want to get the best result, the best terminal wealth, you know, for a drawdown experience. And compound returns are always less than average returns. That's a fact. You know, the average return is always higher than the compound return by volatility. So I'll give you a simple example. You hire someone today, and they make make 100% each period. Okay, so 100, 100 on average, you're making 100%. So if you make the first period you make 200%, and then the next period you make nothing, okay, on average you make 100%. 2 divided by 2 is 1, so both periods you make 100%, both strategies. But on average, you have the same result, but no one would take the, or maybe they would, but you would not take basically the making 200% this period, because if you end up with $1 goes to 3, and 3 times 1 getting your money back is 3, versus 2 times 2 is 4. So the more volatility you take, the less your compound return is going to be. Okay, and also you think about it. You have on average, if you do averages, it ignores volatility. And if you have your friend Peter, and you're at the edge of the river, and Peter asks you whether you can cross the river, and he tells you he can't swim, you say, don't worry about this, Peter. On average, this river is only 2 feet deep. And but Peter's pretty smart, you know, and he'll say, what is the depth of the river right here? You know, and he says it's 15 feet deep is different. So, you know, it's again, it's the average is very misleading, okay, in terms of how to deal with things. And basically, we have only one run of time, okay? So this Peter knows that the 15-foot part of the river is important to him at one run of time. And the averages, or the idea of thinking about distributions, really assumes we have the law of large numbers, which doesn't really apply if we have one run of time. And so every period matters. And also, in the risk of return is much more important in the short run than in the longer run. We have the Sharpe ratio, which is the excess return that one realizes over uncertainty or volatility on an annual basis, is about 0.3. Well, that's 30 units of reward for 100 units of risk. 30 units of reward for 100 units of risk. If you look at it over a monthly basis, then it drops to 7 units of reward for 100 units of risk. So that means risk tends to dominate in the short run. When you listen to the nuts on CNBC, you know, very few of them are talking about means or returns. They're all talking about volatility. They're all talking about risk. The market's going to collapse, they're going to go up, okay? And so compound returns are asymmetric. Larger losses result. It takes you a long time to come back. As I said, I had a friend in '89 who asked the Japanese gentleman who asked me about his advisor said to invest in the stock market, and he was going to retire in 2001. I said, well, you know, it's risky. You can't put all your money there. And he's still working today, trying to get his money back. So allowing risk to fluctuate around average target reduces compound return. So if volatility is your enemy, excess volatility is also your enemy. You know, that means if you have a target risk of whatever volatility level, if you allow your risk to fluctuate around that target, it'll reduce your compound returns. So skewness is important for compound return. Everyone loves upper tails of distribution. They don't like lower tails. So basically, that affects compound returns. And it's really tail losses and tail gains are the most important. I found this cartoon here about the two guys who one sold at the top of the market and the other one bought at the top and the other one sold at the bottom. And so they're asking for money from others. This I just showed you here, that if you keep this, it's interesting. Let's say you take the S&P 500, which is an index of returns. So that's a common thing you hear about, the Dow Jones or the S&P 500. So people say, okay, it's the S&P index is no cost, no fees, and no tracking error. So it's great, right? You buy a passive investment, but it's not risk managed. Okay, so say the average risk of the S&P 500 is 0.15, 15%, and today it's 20% volatility or extra risk. And you say, oh, 20%, great. You know, I can. That means I'm going to make a higher return. So I say you make 20% return when it's 20%, 15% when it's 15%, and then you say, oh, okay, that's great. And so it compensates me. And if it's 10% risk, I make 10%, which is fine. But the difficulty is that the risk is changing over time, and your average return is the same as if you kept your risk constant. And what you can show mathematically is that if you have, even though the expected return is the same, because you've taken excess volatility, you reduce your compound return, and that's free. So managers, when you're managing your money, don't allow your risk to fluctuate if you can have ways to know how to mitigate it and keep risks at target. Now, the interesting thing is, and what really is fascinating and got me to really think about the tails of the distribution, are that, let's say, from Roger Ibbetson's data, that in 1857 you invested in the stock market and large cap stocks in the United States, then your compound return, your excess return, would have been 5% over this whatever risk-free rate you wanted to use during that period of time. So that's a compound return of 5%. Let's say that you were a very lucky person and you wanted a vacation maybe once every 4.5 years, and being a lucky person, you sold all your stocks, okay, out for that 1 month and repurchased them at the end of that 1 month. And once every 4.5 years since 1857, then that was the 2.5% of the worst performing months over that period of time. And then your compound return would have been 9%. So 5% versus 9% is astronomical, because $1 grows to $3,000 at 5%. $1 grows to 1,000,003, okay, at 9%. And conversely, if you were a very unlucky person and sold all your stocks out for the 1 month and they happen to be the best performing months, your compound return would only be 1%. So $1 goes to 8. So you're talking about 1 versus 8, 1 versus 3,000, and 1 versus 1,000,003. Okay, all of the returns are explained by the tails of the distributions, not by the middle. The middle is a lot of random noise. And so everyone who focuses on the middle of the distribution of possible returns, what am I going to do with this? What is 2%, 1%? That is misdirected. You have to focus on the tails. You know, what could be the bad things or what can be the good things that affect what I'm going to do. So look at the Mayweather-McGregor fight. If you look at great boxers, you know, I just put this in, but what it is, all the little jabs, a great box, don't worry about the boxer, jabs, you know, nothing, okay? It's really trying to figure out how to defend yourself against those jabs, but they're not very meaningful. But it's really, you know, being willing to be able to avoid the hit that's going to kill you, or to participate in those things which are going to make your opponent surrender. And here, you know, to show the distribution of returns are not normal. far from it. Tail events are very frequent. This is Bootstrap from 1960 to 2015. And the number of incidents of tails is much greater than what you'd ever expect from a normal distribution. Okay? So how do we get tail risks, and how do we measure it? And there's a bunch of papers in academics, but one is Poon and Granger was awarded the Nobel Prize in Economics, which really say all this back data, looking historically at things, okay? Looking, a lot of what we do in economics and macro policy and everything is we drive our cars by looking in the rear view mirror, and so we explain things perfectly from the past by looking in the rear view mirror, but it doesn't tell us much about where the car is going to go, and so Poon and Granger did the studies and said that options are really the best estimate of returns. And I am saying what we have to do if we're interested in the tails of the distribution, let's get information not from the option market about the middle of the distribution so much. Let's get information about the tails of distribution. And an out-of-the-money put option insures you against large losses. Now, the interesting thing about out-of-the-money options, that's the ones that are, have strike prices that are low relative to, in a put sense, relative to the current market price, is that you have a buyer and a seller. And if there's a person who's making a market or selling protection or selling insurance, it's akin to Darwinian survival of the fittest. You can't sell options for a very long period of time at the wrong price and be able to survive. You'll soon go broke. It's a very levered market, okay? And so basically, if you're going to survive, they're setting prices given what the market is saying, and those people who want to buy protection can't buy protection without doing something, like buying something. So market prices are revealing, and market prices are very powerful. And that's what we see a lot in the development of economics and finance over the years, is how market prices are telling us more and more about what's going on. We're trading individual things, okay, in that. So it's the dark blue and the light green that are really the tails of distribution that are very interested in how you manage money and how you get things. So the way I get the distribution of forward risks in the market are basically to look at the options. Okay, so there's 3 options I depicted here, and every option, a lot of them, like the S&P 500, might have 20 or 30 options that are traded, each one at different strike prices, and each one with a different price. And from the option price, one can determine the volatility. Once you determine the volatility, it tells you the distribution. So there's the red distribution is the out-of-the-money put options, and the light blue distribution is the out-of-the-money call options, which are the tails on the upside, and the black is the middle distribution. And we have those 3 distributions, and what we can do is with a bunch of distributions, as Breeden and Litzenberger showed in a paper, and also Figlewski showed, and under the Black-Scholes technology, that what you can do is by taking the second derivative of the exercise price, you can stitch these together, all these distributions. So you start off with the conditional out-of-the-money option being the red distribution, and then you move then to the stitching to the middle of the distribution, which is the black, and then you move to the blue, which is the upper part of the distribution, and you can compute the tail loss, say the 10% of the worst cases, and the 10% of the best cases. So that's the upper tail of the distribution. So one of the things about the option market, it gives you pictures every day of what the distribution of risks are. Now, there's not much liquidity in options or valuation, not a very thick market for longer dated options, but it's terrific for 2-month options or 3-month options. And options are traded now on over 4,000 securities and instruments around the world. So every day I can know what the price of gold options are, or the distribution of gold risk, or silver risks, or DAX risk, or FTSE risk, or the S&P 500 risk, everything, okay? And the interesting part about risk as well is at times of shock that growth assets, or all assets, tend to become somewhat redundant, because when something's going down in the tails, everything is going down, and similarly when things are going up, they're all going up. It's the middle of the distribution which is very hard to know what the correlations would be. So yeah, you get here, just think about doing a dynamic tail-based Sharpe ratio optimization. I heard that Professor Markowitz may be coming to give a talk, and he talks about mean variance. Maybe he will say you just can't use historical data as well. But so basically, if you look at, this is a bootstrap distribution that looks at the idea of using the information in the option market. If you think about just a 60-40 portfolio of asset holdings, that standard benchmark that universities use and everyone tends to use is the average, you find that on a one-year basis, the compound returns are quite similar, but the ones where you use the information in the option market, you get the blue distribution. But notice that when you manage your money, you want to say, if the risk of downside is increasing, I want to reduce my risk. If the risk of upside is decreasing, I want to increase my risk as given by the market. And then you can mitigate the tails of the distribution. Instead of losing 40% or so, or 30%, you lose 18 or so percent. But that is a huge effect. By cutting the tails and having money to participate in the upside, then you get over a 5-year compounding period. Then you get the blue distribution shifts dramatically to the right, because the power of compounding really takes over, saving some of the downside. If you can save 50% of the downside and participate in 70 or 80% of the upside, you'll have just a wonderful return experience. And that the markets are telling you these information. I've done nothing. I have no model other than just taking the information as a reporter and using what it is from the option market. And here, in the last slide I have, just to show you what happens just with the S&P 500 alone, the Standard & Poor's 500, risk managing it. Nothing about means, because the means are not really that important, just moving based on the risk, either the skewness risk or the downside risk, trying to keep my risk at target and managing it on skewness. From 1996 to 2015, you see in the red distribution is the actual Standard & Poor's 500. The blue distribution is what you'd expect by using the option market information. And then you have, instead of losing 50% in 2 times over the last, since 1996, one when the dot-com bubble occurred in 2001, and 2 in 2007-08, when you drop 50%, you can cut your losses to 25% at the time, but then participate in the upside. So here, you got a slightly greater mean, but when you let it compound, the idea of letting it, cutting your downside and participating in the upside in the bootstrap, what I mean by a bootstrap is you have 1-year sequence of returns, you throw it into an earn, another 1-year sequence, another 1 year, another 1 year, and overlapping, and you throw it into an earn and you sample 10,000 times and see what the distribution looks like. It's the only way I can tell when you have distributions change in shape to be able to show the effects of actually compounding and compound returns over time. You see that on average in the red distribution, you can lose over a 5-year period, you could lose 12% with some probability, or 5% per year with some probability. But if you manage your risk, just risk management alone, not be constrained to just hold the passive portfolio, but to risk manage it, you make great returns. So the future really is 2 things. One is thinking about active management. Can I outperform? Do I have skills to outperform? Which is the alpha world, or the ability to outperform. But just as important, any anchor portfolio you have, that there's the risk managing it, or the beta part is important. So everyone who's just concentrating on outperforming a benchmark, the act of passive debate, is insufficient relative to thinking about, yeah, I can do that, but I can do much better by clapping with the second hand, which is risk managing my portfolio over time. If you ignore risk management, you're not really managing money correctly. You're not thinking about your future. So it's not the mean, it's not this middle distribution. I think focusing on that is not as important as really thinking about how risk evolves over time. When the opportunity set in life or in what your investments is gives you a great positive tail relative to a negative tail, that's when you should invest very heavily, right? And also over time not allow the risk of what you do to fluctuate dramatically, because that reduces your expected experience on a compound return sense or compound value sense. So I'll stop there. Thank you.
Thank you very much. That's actually very exciting. And where can people get the details? Is the paper on your website if they want to get details?
The first half is on my website about the relative value one, and the mathematical equation that you told me to put up is on it. And the second one I'm writing up at the current moment, and I'll have that available soon.
Okay, great. Before we start the Q&A, and some of these questions came from the audience and other people, I want to tell you two quick stories about our guest speaker. So the first story is when I was in graduate school. I had taken a lot of these famous guys, Paul Krugman and other people, general equilibrium theory, and I was utterly depressed. And I went into my office and I was getting ready to take Merton's course at Harvard, and I picked up this book and I started reading about Black-Scholes, and it literally changed my life. And I really mean that. It was the first time I said something really works, and it was a life-changing moment. And I actually flew to New York and knocked on Fisher Black's door and say I need a job. I would have gone to your office, but you were further away. The second story is when Myron invented with Fisher Black the Black-Scholes pricing model. This is 1973, and right at that time, by coincidence, the CBOE started trading options on the exchange, so it was good timing. And Hewlett-Packard, being sort of a leading company, decided to put on their calculator a function that would calculate the implied vol from option prices, so traders could use them to trade options. So Myron and Fisher called Hewlett-Packard and said, hey, you know, it's our model, are we going to get a royalty from this? And Hewlett-Packard said, well, you published the paper, it's in the public domain, so legally we don't have to pay you anything. And they said, okay, thanks. Then they picked the phone back up and said, could we at least get a free calculator? And HP said, go buy one at the local store. That's a true story.
This actually was Texas Instruments.
Sorry,
I don't want to belittle.
Okay, HP's a great company.
No, not HP. Texas Instruments. Sorry about that.
They're both allowable for the CFA. So let's start the questions. So let's go back to 1973. You and Fisher Black were working together at MIT, and there's been some writings on Fisher Black going into a secret black cabinet and other things. Can you tell us a little bit about how those times were and how you guys collaborated and when you had that moment of, oh, we figured it out?
I don't know if there's necessarily the classical eureka moment. You know, sometimes it's a lot of hard work. You know, we had the actual technology in place for about 2 or 3 years, and we were trying to get a general solution without having it be constrained to a model. So our technology was a differential equation that allowed us to make various things. Volatility can change, you know, the interest rate structure can change, the state variables can change. So we tried to figure out how to do a general solution, and we couldn't do it. That's when we decided we better do this in terms of a model which makes some assumptions which are incorrect, but get you a long way to describe what's happening, namely that the volatility was constant and the interest rate was constant. But so it took us a long time to actually work on this. We worked in private in together, and we were doing other things at the same time, other papers and that. So we come back to it and talk with each other about it, and it was exciting. I didn't really realize. I thought at the time we did it, which would enable us to price bonds, and things, existing instruments like options. But I never saw that how once you have technology or once you have a model, a way to do things, that it enables the investment bankers or those in the street to actually build whole new things, that never existed, and basically all evolution of in finance and other businesses is try to satisfy individuals as opposed to provide products, okay? And the investment banking world prior to when I started off was one of having products. So you'd have a banker would issue a product and sell that product to someone else, and they realized with the technology and the modeling that we had developed that you could act as a principal, so that you wouldn't have to find Jones and Smith. You'd say, what does Jones want? Then I can give something Jones wants, and then what does Smith want? I can produce something Smith wants, and then I can figure out how to hedge these risks or to price them using technology that exists. So it made things individualized. Instead of having one shoe fits all, you can now make it shoes that fit me or shoes that fit someone else. I never realized all that was going to happen, but it then strikes you that if you have technology that enables you to do things that are different from, it gives you a map or a way to do things which are far superior. So at the time when Fisher and I were working on this, well, we had started working on this because in finance we had sort of the three things that were talked about as risk management, where one is stocks and bonds, so that you can reduce your risk by holding more cash or more bonds, right? That was one risk dimension. The second risk dimension was diversification, which I talked about. Don't put all your eggs in one basket, and that was the second thing. But there was this thing out there called insurance, out there, and insurance. So I became fascinated with how do we price insurance? Insurance was different because it's non-linear. Sometimes insurance is more valuable, or sometimes it's less valuable, and it's a function of how much in or out of the money you are at any particular time. So I became interested in that, and Fisher had also become interested in it from a different perspective, and then in doing other things we were doing together, we started talking about it, and he had some ideas. I got stuck in certain ways I was dealing with. He was stuck in the ways he was dealing with it, so we married our thinking together, and we then grew very dramatically, and we kept working on this. So we didn't tell Merton or Samuelson, who had worked on option pricing. We kept it in our drawer. It's one thing about protection. You want to protect what you have until you can't, and then I shouldn't. And then the real question about, people ask me a lot, why didn't you just use it for yourself? Why did you publish it? Well, it's one thing when you know a route, before you know a route through the forest, you can say, oh, I'm not going to tell anyone, I'm going to use it myself. But once you figure out what the route is, then you say, oh my God, if I can figure it out, others can figure it out as well. So you have a choice in life. Either you publish it, and you get accolades for publishing something, but then it's a free good. Everyone in life could use it, or you hold it to yourself and someone else publishes it, and then they claim basically that then others publish, and then you can claim all you want, but it's too late at that time. Like Darwin, right? He wrote for years and years and years. He did all these studies and didn't publish, and then this other guy, I think was it Walker or someone who had, was going to publish, but then he said no. Darwin had discovered it first, and he allowed Darwin to have the accolades. But so you got to think of science. We always knew we were going to publish it, but we didn't want to tell competitors too quickly. But they initially said no. They didn't believe what we were as correct in that, but after a while we convinced them I was correct, and then they went off and did it as well.
And how has your life changed since you won the Nobel Prize?
Well, I tell people if you get the opportunity to receive the Nobel Prize, don't turn it down.
Anything special though? anything? What did you think about Fisher Black not making it? Because
well, he did not make it. I mean, I felt badly, but he passed away, and basically in 1995. And a person is not awarded the Nobel Prize posthumously. There's a very special case. You can be awarded the Nobel Prize, die before you receive it in that 6 weeks, okay, and then you still are given the honor. But you have to be alive to be awarded the prize. But it was very clear in the accolade, in the citations and that he would have won and been awarded the Nobel Prize if he had lived to do it. So I felt badly that he was not a recipient.
So those days at MIT...
But I made more money. I made more money. But
those days at MIT were super creative, and it's not always easy to create a creative environment. For example, some people think free speech is under attack today. But I guess my question to you really is, what advice do you give to others to create and foster a creative environment so ideas can be born?
Right. Well, what I say to people, I say, go where the best are. Go where the best are and steal everything you can from them. I really mean that seriously. But the point is, to go where the best are and steal from them, they got to be able to steal from you. So you got to be the best too. So everything in life, you want to be the best for you, which is the group that's the best for you, that you can create the most and learn the most, and from. And if you're not learning from the group you're with, leave, right? If you are learning and growing in that, then stay, So that's what I have learned. And when I was at MIT, with trepidation, I'm a young nothing guy, it's just starting off, and then talking with Paul Samuelson or Solo or Modigliani or, Bob Merton came after I was there, but other great people, or in other things when I was at Chicago, to be able to work with Merton Miller, who was awarded the Nobel Prize. So my mentor was awarded the Nobel Prize, and then Gene Fama, who I also was with, was awarded the Nobel Prize. So it's basically, steal as much as you can. I really mean that. I think it's not bad. It's one thing. I don't understand why we said don't copy other people. It's mimicking what other people have done, trying to understand, listen to them is great. Having to do everything yourself is impossible in life, and being able to do that is very good. But you have to realize you got to push yourself. If you're the best, if you want to go and get from the best, you got to be for them the best as well, and then you got to, or else find a new group.
Who was you mentioned some names there? Who was a mentor of yours, and can you describe the greatest lessons that they taught you, and what are the greatest lessons you have taught your students?
I wish I had taught them some great lessons, but I guess for me, I was in my first year at University of Chicago. I saw a sign said computer programmer needed. Okay, and so this is for a summer job, and I didn't know anything about what a computer did in those days. Not like you guys have all your computers in your pocket, and that the big mainframe machine that couldn't do very much of anything. So I went to the dean and I said, "Can I have one of the computer programming job?" And he said, "Well, yeah, you're number 7." I said, "I don't know anything about a computer." He said, "You're number 7." And the first day in the office, no one other than myself showed up. By the third day, I was the only guy there, and the professors were all coming around wanting research help, in programming. And so I went to the dean and I said that, where's the other 6 guys? And they didn't show up. No one showed up with me. So basically, I didn't know anything about a computer, and I was a computer programmer, and no one else to be there to shirk. I couldn't shirk at all. So I became a computer nerd that summer. But what I did was, I was amazed at how the professors loved their research. Merton Miller or Peter Pashigian or Lester Telser or Gene Fama, who came in and asked for my help. I said, if they love their research as much as that, that's for me. You know, basically, it must be good. You know, the guys who love their research. So I said, okay. At the end of the summer, they told me, he said, well, I said, why don't you, the professor said, why don't you go in the PhD program and get your PhD? And I didn't know whether it was because of my programming ability or because they might have thought some ideas were good for them in terms of things. But I never, they gave me a fellowship, scholarship, money, and everything. And that was serendipitous, just luck, you know, but it was, for me, is realizing, again, this stealing thing or mimicking, you know, realizing what really intrigued other people, what they loved. And if you can figure out what they love, why could you love that? You know, if I loved economics and that, so it was there. And what I've tried to give to my students is really, there's research in life, researching what other people have done. Going and research, that's what research is, you know, adding an I and a T. It's a wonderful part of science and life. But I said, you got to have some things in your life where you're searching. You know, don't be trapped by what others have done. Search for other things. Search for new creative things. Don't think that I have to be vertical, you know, go right so deep into things that I don't see the path to the right or the left. You know, just don't down that narrow focus. So I've encouraged my students, my PhD students and others in that, to do some searching. You know, don't worry if initially you're not going to exactly figure out what's going on. And I think that's important to, you know, balance those things and to be able to figure out how to search in addition to do research. I think there's, unfortunately, the academic world, which I was in for a long time, and probably even true in other worlds, really only rewards you if you have publications. And so when you get your PhD thesis, you try to do something the professor is interested in, you know, hedge your bets and do that. And so it creates too much vertical activity and not enough horizontal or looking at the right or left.
Related to that, is there something a family member of yours has taught you that has served you well in your lifetime?
Well, yes. I mean, my mother passed away when I was 15, and you know, in the years prior to her death, I spent a lot of time talking with her, and it gave me a different perspective on life. And let me say that, you know, life is short. You got to take risks. You got to think about what makes you go as me as a person, and what I'm interested in. And don't worry if you fail. You know, the objective is know yourself and go back to your principles of yourself, and don't cheat. I'm not saying, you know, don't be a cheater in that, but understand that you only have, you know, paraphrasing what I said earlier, you only have one run of time.
Okay, now we're going to move to finance questions. But before we start that, I'm going to mention some people that were influential in economics and finance and just get your one sentence or first thought that comes to your mind on each person. Fisher Black.
Fisher Black was just a great inspiration for me, and you know, I learned a tremendous amount from him because he came from a completely different perspective than I did. He came from a physics background, you know, to start with, and didn't know economics. So basically, I knew economics, and I married together his thinking on physics and mine, and I think we had a much greater result as a result of that collaboration.
Bob Merton.
Bob Merton's, you had Bob Merton here, so you know what he is. He's a very wonderful fellow and very creative, and I've learned a lot working with him and being with him. A good friend.
Merton Miller, who was your advisor?
Merton Miller was tremendous. I mean, we were on a PhD committee together, and a PhD candidate took 21 years to get his PhD. and Merton stayed with him the entire time. He was a real scholar, you know. It was interesting. He he's actually started off as a history of economic historian before he went into finance. But you know, a terrific terrific person. It's a pleasure for me to having worked with him and written papers with him.
So recently Steve Ross died, who was a big person in finance. Steve Ross.
Steve Ross was great. I mean, he came into the profession from Caltech after starting in a different area, and you know, he, like you, I love Steve because he said, like you, he really thought finance was terrific once he started thinking about reading about options and thinking about that. But he did some very, very creative work in, especially with arbitrage pricing theory. And you know, when someone does things that you didn't think about, and you say, I wish I could think about those, have done it that way, then you know, I clap to that person, give claps to that person.
Gene Fama, another one of your advisors.
Yeah, Gene also, I mean, Gene is a terrific empiricist. I mean, it was wonderful to watch the way he loved doing research and the data and working with data, and how he persisted, and his work ethic was unbelievable. You know, he got in the morning, was always there before I was, and he always was home after I was, and he ended up having 4 children. I don't know how he did that.
So, putting you on the spot a little bit, Fisher Black used to call, and he's, I think, written publicly about it, he called Gene Fama a data miner. Do you have a reaction to that?
Well, I could, yeah, I think that all of us data mine, okay? The interesting thing about science is that we're all inductive. You know, I don't think we can be deductive without cheating, if you want to think about data mining, by looking at history or looking at things. So we look at history and then we build a model based on history. And then, unfortunately, we go back and test the model exactly on the data which we developed our thinking from. So, but that's all science. I mean, science, you know, I don't know if anyone could do something purely from, without ever looking at anything in history or looking at anything that would change their views about, fashion their views. So if you think about, that's the wonderful parts about science, that's the wonderful part about our creativity, because we know we data mine, we know that the information set is gigantic, and we take a piece of that information set, we build a model, and then we try to go test it, and then we use the data. So that's what we have, that's our life, okay? We don't have a way to just be deductive. So if you are inductive, then the great scientist or the creative person is either lucky and they took the correct data, or they know what data to gather and when to stop. And I've seen many people who've gathered too little data from the past, and I know so many other people who just kept gathering data and kept gathering data and never deduced anything. So the genius or the creative person is to data mine or be inductive, but know when to see something different and to be able to create something which is very valuable. So I don't necessarily think data mining is bad. I think big data and all the things we're going to do just have to know how to be creative using it, and what it tells you what you can't do and what it tells you it does do.
Okay, we have a couple more people and then we'll get to the other questions. Harry Markowitz.
Harry Markowitz, I didn't know Harry Markowitz very well. Harry Markowitz obviously is sort of the father of portfolio theory, and I read his books as a student, you know, read his work as a student, and it's just very creative, you know, so I'll stop there.
Okay, I'll move on to some of the questions. Black-Scholes was probably one of the most important discoveries in finance and economics. What other discovery do you think is of that magnitude?
None. No, I obviously in economics, okay, that was how to price uncertainty. Obviously, that idea that market prices, deciding that market prices are the key thing, one of the key things in economics, you know, going back to Marshall and obviously to Adam Smith were wonderful discoveries in that, you know, I mean, and those, there's just more, there are many fundamental things, but that was one of them that's really crucial.
And today, what do you think, what is missing in economics that people should be focusing on?
There's lots of things that we have yet to do. I mean, I think we really only broached the surface of how to think about uncertainty. We need all new models of macro. Macro models are all broken. They're based on bad theory, and I don't mean to knock anyone's profession here in macro, but in my own thinking of it, we're all based on certainty models, you know, and the like, and that basically we have to think about how uncertainty comes in right from the start, you know, and build models again from the ground up and work that way. So we have a lot of work to do with macro. You know, macro models didn't have anything about finance in it until 2007, 2008, you know, and they had based on frictions and things like that. And our micro world, you know, is all based on frictions again, the idea that we've seen nothing yet in terms of how it's going to be, economics is going to change with the idea of the internet and big data and robotics and that, you know, and all that's going to change. And you know, we have, and also we haven't really have great political economics anymore. We split political economics into politics and economics. And with the advent of Asia and the politics or the philosophy of the East versus economics and the politics and philosophy of the West, you know, how are they going to mesh together when we have a world that's getting smaller and smaller? And what is that going to do in terms of how this economics is going to evolve over time? So there's huge amounts of research and thinking to do. And we're going to end up in a clash between the China and the West and the U.S., you know, because our philosophy is so different from their philosophy, and our economics are coming together and clashing quite dramatically. So there's lots of different things that in my remaining 63 and a half years I'm going to work on.
Okay, one more question, and then we're going to go to the dean to ask the last question. Out of all your accomplishments, what are you most proud of and why? And this can even include personal accomplishments instead of professional.
Well, other than my having 2 wonderful daughters and 4 grandchildren, you can see that I relish them and legacy, so I'm consuming through them, which is really terrific. So, but I think that I think one of the things that accomplishment I like about myself is that I love learning or trying to learn new things, and so that to me is a good accomplishment, because I think if you know everything, you know, I think you know nothing, and so I keep trying to learn, and so and since uncertainty has been my benchmark of like trying to understand uncertainty or get uncertainty, it's allowed me the freedom to read very broadly, from history to history of war to politics to philosophy and other things, and you know, to see how other people think about it, or physics, mathematics, you know, and so that I just felt my being lucky and wanting to understand uncertainty or really think about uncertainty is, you know, for me is a good accomplishment.
Okay, thanks. Why don't we give the last question to Dean Davis?
Thank you, Ludwig. So this was really difficult. First of all, thank you for your presentation. But tonight is very much about the education of our students. So I get to ask the last question of the night, and I have to tell you, as I was sitting in the audience, I thought this might be risky, a little bit risky, to ask you this last question, but I actually knew that you would not give an average response to my question. So I ask you to really, as you reflect on your career and the different experiences you've had, and you've given us some insight into this question, What advice would you give to our students to best prepare them for future success in life and their careers?
Man, that's presumptuous. For me to answer that, I think that basically, look after your bodies, look after your heart, keep learning, and realize that you have learning as a lifetime experience, and that you have to really think about learning as much you can in any particular way that you can, and it's fun. I think if you keep learning, it keeps you young. I find that for me, it's I'm very old, but I try to keep learning, and as that part of my life is very important. So learn from your fellow students, and realize. And interesting enough, I mean, talking about this earlier, someone asked me a question earlier, but how we learn and how is so different for different people, and so you have to figure out how you learn and how the best model of how you learn. And I learn in a particular way, other people learn in another way. Ludwig, I know, is a great golfer. I didn't tell him this, but before I even swung the club once, I read 141 golf books on how to play golf. So I learn in different ways, But I still, unfortunately, when I tried to swing the club after the 141 books, the ball didn't do what I thought it was going to do.
Maybe stealing a few techniques, too.
Well, I try to steal from the techniques from the books, but so in life, okay, theory is what I'm trying to say. Theory is important. The books are important. Theory is important, but experience is important too. So how do you marry theory and experience together in the right way? And how to do it is very important. So just don't be experiential, because that's good, but not the way to do it. Don't be just theory, because that's not good. So I think the combination of both are important. So in your educational things, you're giving a theory, but remember that professors don't have enough experience. You have to figure out how to get the experience either from your students or others to be able to make it a richer environment.
Great. Thank you so much.
You're welcome.
Practice.